Welcome to Wealth Matters Podcast. How are you, Brett, today?
Alpesh, I'm better than I deserve. Thanks so much for having me on.
Absolutely. So, Brett Swarts is the founder of Capital Gains Tax Solutions, and he's also the host of Capital Gains Tax Solutions podcast. Each year, he equips hundreds of business professionals with the Deferred Sales Trust tool to help their high net worth clients solve capital gains tax deferral limitations. He's passionate about educating people in capital gains tax deferral with Deferred Sales Trust, which DST, which we'll be talking about on this podcast. And pretty much DST is used to how divest from a business or real estate and gain freedom from feeling hostage to a 1031 exchange, and then invest back into a new business venture or investment real estate at any time. So welcome, Brett, again. We'll be talking about DST, but can you tell us about yourself? How did you get into DST, and do you personally invest in real estate?
Yes, thanks, Alpesh, again for having me on the show. And let's talk a little bit about my origin story. So I grew up in the Bay Area, originally from Mission, San Jose, Fremont area. Learned about the sticks and bricks of real estate and how to really develop and own and cash flow and really just make wealth in real estate. So that's my beginnings. And that moved to a passion of studying business in college. And from there, joining a company called Marcus and Millichap, where we learned
Of
how to help
course.
people buy and sell multifamily properties here in Northern California. And so I learned a lot there. And on about day 3, we learned about the 1031 exchange, about how to help people defer taxes when they sell investment property. But 2008 hit, and when that hit, everything kind of changed really forever, I think, for a lot of people, especially for building wealth and buying real estate and being a little more cautious. And as a part of that, we saw a lot of people get hurt. You saw friends and family lose everything. We saw clients lose everything. We saw people who earned wealth for 20 or 30 years and then overpay for properties and then lose half or everything when the market crashed. And so we sought out on a mission to really help find an alternative to a 1031 exchange so that our clients, our friends and family would not have to be faced with all of this debt and having to overpay for properties. And what was considered before the '08 crash a highly appreciated seller's market. And so fast forward 10 years, I've been educating my clients, friends and family on this structure called a Deferred Sales Trust. By the way, not to be confused with the Delaware Statutory Trust, which a lot of people think the same thing. It's not. They're both DSTs. So here we are.
That's awesome. So what is a DST and why someone should use it?
Great question. So a deferred sales trust is simply an installment sale. An installment sale is, for your listeners, maybe known as a seller carryback. That's what it's most commonly known as. It's based upon IRC 453, which is the IRS tax code. 453 goes back to the 1920s. So it's a tried and true tax code. And it would be such as, Alpesh, you're selling a property, let's say a multifamily property for $5 million, and you were carrying paper. Well, if you carry paper, you become the lender. You don't pay tax on what you have.
You are the bank.
You're the bank, right? So that's what it's based upon. As far as why someone would use it, we're seeing just a huge shift in demographics and wealth. And I'll give you a few stats for your listeners. According to the American Bankers Association, there's about $17 trillion that will pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet that we know. In fact, there's about 10,000 baby boomers turning 65 every single day in the U.S. alone, and about 77 million baby boomers in the U.S. alone. And what are they challenged with? Well, they're challenged with toilets, trash, liability, debt, businesses that they've worked on for 20, 30, 40 years, properties that they've 1031 exchanged for decades, and highly appreciated assets, right? But they want their time and energy to do retirement or to slow their pace of life. A lot of them do, and they don't want to necessarily 1031 into another property, right? But they got to sell, or they want to sell, but they don't know how to get out without getting 30 to 50% of their gain being wiped out. And that's what we're talking about here. Every single day, people pay hundreds of thousands, if not millions of dollars on their high-end primary homes, their businesses, or commercial real estate
Right.
when they don't have to. They can use the Deferred Sales Trust to get out of all of that, get out of all the debt, and to diversify it into multiple income stream assets such as real estate or stocks, bonds, and mutual funds, all tax deferred. And that's really the big secret here. Most folks know how to defer tax using some strategy, but they don't know how to do it to open up the whole of options for real estate or stocks, bonds, and mutual funds, and then to do it at their own timing based upon their own needs.
Huh. You brought up a good point on your own timing. So how do I sell high and wait on the sidelines and or buy or develop real estate on my own timing, all tax deferred?
Excellent. Great question. And I'm going to use two case studies, okay, that deals that actually closed.
Oh,
By the way,
really?
we've done a
Nice.
couple thousand of these deals now. Yeah, a couple thousand of these deals now. And I found case studies to be the best way to really understand this.
Yes.
Over 24-year track record, 14 no change IRS audits. The biggest deal was a $125 million investment
Wow.
real estate deal in San Diego. Okay. So that being said, this recent deal just closed just a few months ago. This gentleman's name is Peter. He's driving out of Marin, California. And for your listeners who I'm not sure where that's at, it's north of San Francisco. And he's driving to Sacramento 3 days a week. And he's driving to a place known as South Sacramento. It's a tough neighborhood. And he's trying to collect rents. He's evicting tenants. He's dealing with the toilets, the trash, the liability. He has 18 units. And he's tired of all of it. He's close to 70 years old, and he's going, I don't want to deal with this anymore. I don't need any more wealth.
Right.
I've made plenty of money, but I don't want to just squander it by just selling it and either overpaying for a property that I don't want to do, or B, paying all of this tax. So he owed about $500,000 in capital gains tax and depreciation recapture if he were to sell. So he sold his property for about $1.9 million. He owed about $500,000 of liability, and he had about $500,000 of debt. And so for him, he decided to use the Deferred Sales Trust
Mm-hmm.
and get out of all of the debt, defer all of the taxes, and put 100% into the trust
Oh,
instead of
okay.
doing a 1031 exchange. His biggest thing was, Brett, I want optimal timing. I don't want to overpay for a property. I already went through this in the '08 crash,
Right.
and where he had bought and sold via 1031 exchanges. And so he said, Brett, I didn't want to trade 18 problems for 36 problems. But more than that, I found a great deal. Like I'd probably figure out a way to do it. I just can't make sense of these 4%, 5% cap rates with these rents that have been so pushed so high. There's not enough margin here, and a lot of the value has been added, and it's so competitive. So he goes, Brett, if I could find a deal, great, but I haven't been able to find a deal. So I wasn't a seller until you brought me the Deferred Sales Trust. He goes, I didn't even know it was available, but now I can sit on the sidelines, and that's the beauty of this. So now all the funds go into the trust. He's sitting on the sidelines. And tomorrow, if he finds a deal, we haven't found one yet, or day 181, or a couple of years from now, he can basically direct the funds up to 80% to a brand new LLC, of which he's the managing member of which
Okay.
he goes and buys another piece of property. So it's as simple as that. You're going to do what's called a JV partnership with the trust, and the trust is going to be a silent partner on the side.
I see.
And Peters can own real estate of his own, or he might put it with a Pesh on a deal, or a
Right.
different property or different syndication deal. So it's really as simple as that. It's kind of like a self-directed IRA, right? It's
Uh-huh.
kind of like a 1031 exchange. It's kind of like a mixture of a few things, but it gives you tons of options.
So I have some more questions, of course. Let's say I have a property, or my friend has a property, and there is a gain of couple of $1 million, and he decides to sell or thinking about doing 1031. When should he reach out to you? Is it after selling or
Right.
right before selling? What happens?
Great question. So we need to be early. So the answer
Okay.
is you want to engage and work with us before you sell the property, right? You
Okay.
want to make sure you get everything in a row, because the key is what's called actual receipt. So if you close escrow on a property and or buyer has removed all contingencies, okay, it's too late for us,
Oh,
okay?
okay.
Because the government's going to say it's already came. There's one exception to that. If you do a 1031 exchange, and you work with a proper 1031 exchange company that lets you do both the deferred sales trust and the 1031 exchange, then we can save a failed 1031. But let's just focus on the first one. So if you're
Right.
selling a primary home, we just did a deal in Cupertino, $3.1 million primary home sale, and we helped her defer $380,000 in capital gains tax. That didn't qualify for a 1031, right? So primary homes, you only have
Right.
what's called the
There it won't.
121 exclusion. You lived there the last 5 years. You have 250 for single, 500 if you're
500.
married. She sold her house for 3.1 million. Above and beyond her exclusion, she still owed about $380,000 in capital gains tax. She had lived there
Wow.
for lots of years, and it's just 3 miles from Apple. So for her, we had to set it up before close of escrow.
I
Okay,
see.
because she has no 1031 option. So we worked with her for about 30 days before escrow close, and then the funds went in. So that's number one. Number two is a business sale. Same thing. We need to have it before the business closes, but even more so before the buyer removes all contingencies. Because if the buyer removes all contingencies, it's deemed as what's called constructive receipt, meaning there's nothing that's going to hold up the sale from closing except from you collecting the cash, and that therefore it's basically as if you had it in your hand. So that being said, you contact us, you connect with us. We'll give you the language to put in there, and also help educate whoever you need to educate, so that you have this option. But once you establish that language inside the purchase and sale agreement, then yes, we'll do it at close of escrow. That's when everything will transact, and that's how we keep you safe and keep the money tax deferred.
That's so I'm gonna throw a curveball at you. Let's say if buyer removed the contingency and I find out about this DST, this is amazing. And then as a seller, can I cancel the contract and then redo the same contract? Or can I ask the
Yeah, so you got to be
buyer
careful
to
there, right?
do that?
You got to be careful there, right?
Uh,
So that's it's sort of like seller beware, right?
yeah,
Because that's where we don't want to get in any gray area
I
where
see.
you're looking at tax avoidance, right? Or you're looking at, this is tax deferral. And if you start doing things outside of our framework or thousands of closes in the 14 no change IRS audits, then you're looking at areas where if the IRS did an audit and they saw the evidence, they could say, well, that's exactly what you just did there. So we would not recommend that, and we would say, uh, no, don't do that. Just pay the tax on that deal. On the next deal, we'll help you out.
I see. Also, you just mentioned, so this is similar to seller financing, but it's MIS, right? Monetized installment sale. So most of the proceeds go into the trust, right?
So to clarify, so we're not the monetized installment sale, although the
Okay.
monetized installment sale but this is a good time to bring it up because it does get confused with the two.
Right. Yeah.
They are sort of a competitor, but they're under IRS review. They're under a big court case, and there's lots of big question marks to remain.
Oh, really?
So which
Okay.
leads into, but they are a form of an installment sale. That's what they're using, IRC 453. So we're a deferred sales trust. So you want to ask really 7 main questions when anyone's bringing you a brand new strategy, such as the deferred sales trust, such as the monetized installment sale, such as the charitable remainder trust, 1031 exchange. The first one is, what's the tax code? We're IRC 453. How many have been closed, right? So how many of you have the company closed or the structure closed or the attorneys closed? Of those, how many have been audited,
Mm-hmm.
right? And how many of those audits survived the IRS
Right.
scrutiny? And how many of your actual clients were audited? Okay, this is getting even more granular. You want to make sure whoever is bringing you this structure and this advice has survived the scrutiny from the IRS. And with the deferred sales trust, it's been thousands of closes, 24-year track record, 14 no change IRS audits, including 2 formal audits, not one single issue. The monetized, what we've heard, what we've learned, it's been around maybe 5 to 7 years. They may have maybe a couple hundred closes. We don't know if they've ever survived an IRS audit. We don't know, especially for their actual clients, for those who are educating people. And then also they're underneath right now, I think a lawsuit. You can go online, you can find that. And so you don't want to go with something where, again, it hasn't been tested, hasn't succeeded, and then second, it's under an actual live lawsuit, because if you do, you're opening up opportunity for perhaps for that to fail. And if it fails, then you're going to owe all that tax. Okay.
Ah,
The last one is you want audit defense. You want someone to protect you and
right,
not to have it come out of your own pocket. So with the Deferred Sales Trust, we provide audit defense at no additional charge to the client for lifetime audit defense, including as part of the one-time fee for the upfront cost. There's some ongoing costs too, but essentially that's very important, right? Because you want someone who to be able to
right.
protect you in case the IRS does come knocking at your door.
That's awesome. So let's go back. So as DST, as soon as I sell the property, you have created a trust for me, and that trust would have 100% of the proceeds. And then you mentioned about 80%. So what does that mean? So 80% of the money is available to me next day, or how does that work?
Right. So at any point, by the way, you can cash out of everything and pay the tax. Okay. So, but if you
Right.
want to stay 100% tax deferred, okay, if you want to stay 100% tax deferred, you can put 100% of the proceeds into the trust. But some people might need a little bit of cash or want a little bit of cash. That's fine. 5, 10, 15, 20, whatever amount you want or need, you're going to pay tax on that when you receive it. The
Okay.
notes are structured as 10-year notes, and every 10 years you can renew for another 10 years or another 10 years and keep renewing. Typically about 8% is the target interest rate. After fees, it nets about 6.5%. But at the end of 10 years, we're hoping to net 8% minus the fees. So that being said, you're going to pay ordinary income tax as you receive that,
Right.
and the other amount you're going to pay capital gains tax as you receive that portion there. The funds are in the trust, and then you want to perhaps invest into investment real estate. So this is the 80-20 part. Okay, so you say, well, Brett, I found a real estate deal. It took me 7 months to find, or it took me 7 days to find. Doesn't really matter, but you find it. Let's just use an example of a $10 million sale. 10 million is in the trust. $8 million is now available to be put into what's called alternative investments, such as investment real estate, such as a new business startup, a new
Okay.
tech company startup, developing real estate. But here's the key: it's all tax deferred as long as you do it properly. What's properly? By setting it up with us in a brand new LLC. You're the managing member of it, and then the funds, with your authorization, get sold out of, let's say, the stocks, bonds, mutual funds over here, and they get moved to the new LLC bank account. And as long as that LLC is in business purpose, in which it's investment real estate or a business venture, it's still tax deferred, right? It's the same way a 1031 works. The funds go to the QI company, and then
Right.
it moves over to a new property, sometimes a brand new LLC. And then what do you do? Well, you're owning and managing that property,
Uh-huh.
but it's business purpose, right? It's investment. If for some reason you put it into your primary home, those funds, or you put it into like a, traveling and cars and stuff, personal property, that's taxable. That's not good. It has to be business purpose, and that's what we do. We're going to coach you, consult with
I
you and your
see.
trusted advisors along the way to make sure you're staying within the guardrails to keep this structure going.
Got it. So let's and of course I invest in real estate. So I have been talking only about real estate. I'm glad that you brought up business as well. You can sell business and maybe others similar investments. But in real estate world, let's say I had a rental property, 10 unit or whatnot. You just gave an example as well. I sold it. I put it in DST and I found another property, real estate property. What happens to the depreciation? In 1031 world, your new property has the same basis, right? So your depreciation, which was carried over, would still be carried over, right? But what happens in DST world? Do I get a brand new depreciation, or do I have to declare the whole depreciation as
This is one of the best kept secrets. You get a brand new depreciation
really?
schedule, and this goes back to
Really?
the foundation of the differences between IRC 453 and IRC 1031. So they're both tax deferral structures, okay, strategies, tax codes. One, the depreciation schedule travels. This other one, it doesn't travel. You get a brand new depreciation schedule. So let's walk through an example for your listeners. Imagine you own a multifamily property for 27 and a half years, straight line depreciation, you're fully depreciated. Let's imagine you're selling it for $10 million. Well, if you do a 1031 exchange with that $10 million property, you buy a $15 million property,
Right.
guess what? You only have $5 more million of depreciation to take.
Correct.
The other 10 million is you can't take. Well, with the deferred sales trust, you could buy that same $15 million property, and guess what? You get a brand new depreciation schedule, right? That's very powerful because now we can do what's called accelerated depreciation, and we can use that to offset the income drastically on not only the property itself, but also on the trust itself. We call this tax engineering, all 100% legal. And the key is it's a different tax code. It has different rules. So that's one of the number one advantages for this. The second one versus the 1031 has to do with what's called the sell high, buy higher 180 days later. I think it's
that's the biggest problem.
Right. The biggest problem is you get stuck in this 45-day window where you have to sprint around, run around, and find something. So our parents taught us to sell high and buy low. They didn't teach us to sell high, buy higher 180 days later, and maybe take on even more debt. No. Right now, we think it's a great time to be on the sidelines. So we're coming off 2 weeks, a week and a half of the stock market really getting hurt by the coronavirus right now, depending on when you're listening to this
it's down 2,000 points.
Yeah, it's down. It's down. It's getting hammered, right? So we like to say get out of debt, right? Get diversified, get liquid, right? There are safe things you can put it in. I'm real estate by heart and I'm biased. I love investment real estate. It's my number one way to invest. However, it's good to have diversification too, right?
Yes.
At a certain point, you want to get out of the debt. You want to be on the sidelines. You want to be liquid. You can be in very conservative stuff. And then you can also, again, you can diversify within commercial real estate syndication. So you may not buy an $8 million property by yourself. You may put $1 million into for 8 different syndicators, right? Operators and mobile home parks and senior housing and multifamily and retail and industrial. In different geographical locations, right? So all of a sudden, the 1031 exchange, it's by definition, it's really not diversified because you're typically trading one property for one other property within that 180 days, and oftentimes the same product type and the same geographical location, right? Because most sellers, that's what they know. They only know they're only that area.
And I'm glad that I'm glad that you brought that up. And guys, Brett and I have not spoken about any of this. I just threw curveball at him asking about depreciation, right? So, but what he mentioned, and I'm surprised that him and I follow pretty much same standards of investing. I invest same way. I try to diversify in different geographical locations as well as in different industries. And what you mentioned, mobile home parks, self-storage, apartment building, I invest myself. I put it in different syndications with different syndicators. So it gives me, a lot of leeway. Even if the market corrects, I know that some industry would do better than the other during recession as well. And again, I'm not predicting any of that. But this is huge that I'm able to get a brand new depreciation and then comparing it to 1031 where I have to buy a property bigger and with the hard price, right? So if I sell a $10 million property, I got to buy something which is more than 10 million, right? And then of course, talking about the diversification. So this is amazing.
It really is. It's that amazing. We say it's that good to be true. And we sat in the office at Marcus and Millichap. We learned about it for the first time in about 2009. And we sat there going, how do we not know about this? Why hasn't my CPA told me about it? Where has this been? And it's really been a journey of just getting educated. And that's why I encourage your listeners to reach out to us, bring in your trusted advisors. And once you understand it, like the 1031, you probably know that really well if you're listening to this show. You're going to be empowered by it, and it's really going to shift the opportunity for you to, we call it the blue ocean versus the red ocean. The red ocean is where all of the sharks are at, and all the sharks are just doing 1031s, overpaying for property, taking on debt. Everyone's running around. Whereas the blue ocean, you can use the deferred sales trust, and you have a wide open, peaceful, diversified, debt-free anytime you can buy, all tax deferred, which leads me to the next point here too. For any of the ultra high net worth clients or individuals listening to this podcast, you're faced maybe with what's called the estate tax, and this is the other downfall of the
Yes.
1031 exchange. Most people think the reason the 1031 is the end all be all is because I can just keep 1031 in,
1031
and then
till
when
you
I die, my
die.
kids get a stepped up basis. Right. Just exchange until you die, baby, you know? And there's truth to that until if you're worth more than 11 million single or 22 million and married, okay? Because all of a sudden you're in another bracket called the estate tax. Not really a bracket, but you're subject to another tax called the
Yes.
estate tax, which by the way has nothing to do with the stepped up basis. So let's
No.
walk through that. Let's imagine, Alpesh, you're married and you're worth $52 million today, and imagine your estate passed tomorrow, and imagine all 52 million was inside the taxable estate. Okay, well, you get the stepped up basis, so your kids are really happy because they're
Right.
not paying any capital gains tax, but the estate is still 52 million. It doesn't move it
Mm-hmm.
outside your taxable estate. So that first 22 million is exempt. That's great.
Right.
But the next 30 million is subject to that 40% death
Right.
tax. And this is brutal. That's $12 million on that 30 million. So
Yeah,
the
that's
problem is
crazy.
too much is inside the taxable estate. The intent is to get it outside the taxable estate. The challenge is most people who are ultra high net worth have also done gifting and FLPs and have
Right.
done some stuff to help with that, but they can't get it out fast enough. They say, I'm running out of gifting. I'm running out of my exemption per year.
Uh-huh.
I still have all of these funds inside my taxable estate. The solution is the Deferred Sales Trust. In one single transaction, because we are not a 1031 exchange, and because we're using this third-party business trust to do this transaction, we can not only, let's imagine, sell your $30 million apartment complex tomorrow, but in that same day, move it all outside the taxable estate, which does what? It saves you $12 million
Right.
day one. So that's the part where the 1031 exchange we blow out of the water. It doesn't even come close, right? And then of course you add on the optimal timing. Then
Right.
you add on a new depreciation schedule. And the last one I'll give your listeners here too, unless you have more questions on it, has to do with what's called the net income tax savings. Okay, so imagine you own that $10 million property again, and it's producing, $500,000 of cash flow every year. Again, you're getting some depreciation, but
Right.
maybe you ran out of depreciation. You're having to take that and pay the income tax. Okay, well, if you sell that $10 million property, move it into the Deferred Sales Trust, and you can tell the trust basically, I don't need or want those payments right now. Let's delay those payments for 3, 4, 5 years, and let's let that $500,000 just compound on top of the trust. Well, guess what? Alpesh, you're not receiving that in that given year. Therefore, your tax bracket perhaps goes smaller,
Right.
right? Now, you stop working your day job, right? Or you stop working whatever, and now your income goes
Now you
smaller
can.
here.
Yeah.
Now, over here, you start building this, you start taking over here. So we call that the net income tax advantage, which the 1031 doesn't give you that option to do.
That's amazing. So, how do we know this is legal, and what kind of fees are there, etc.? Track record, do we need to check all that?
Yes, most important question, right? How do we know it's legal? Kind of goes back to that initial 7 questions I said to ask anyone who brings you any tax deferral structure. The first thing is, what's the IRS tax code? IRC 453. What's that? It's a seller carryback. Okay, good. How long have you guys been doing it for? 24 years. How many have closed? Thousands. The most important question: how many of those have survived the IRS audits? Okay, that's very, very important. But I also want to let your listeners know. You go to a general practitioner, let's say for 20 years, for your healthcare provider, and he's provided you blood work, and he's
Right.
given you medicine for the common cold. He's provided general things, but there's times where you might need surgery. And this is
Uh-huh.
one of those times where you might need an ACL surgery, or you have God forbid, a
Right.
tumor. We like to say it's kind of like this capital gains tax of 30 to 50%. It's kind of like a brain tumor. And your general practitioner has never done it before.
Right.
So they're going to say, whoa, I've never heard of it before. I'm not sure. I'm not sure if you should get surgery. It sounds dangerous. Well, here's the questions you want to ask. How many patients have died? For ours, 0. Meaning, how many patients have gone to jail? 0.
None.
How many have these not worked? 0. All of them have worked 100% of the time. We have also 14 no change IRS audits. And this is actually really remarkable. No change. So imagine, Alpesh, you and I got audited today on just our regular business or real estate. What are the
Right.
odds that the IRS would say, not one single issue?
It's very
Probably
rare.
one in a million, right? They find something,
Very rare.
Alpesh, you
Of
went
course,
to
that's their
Puerto
job.
Vallarta and you said, yeah, it's their job. You went to Puerto Vallarta and you spent all
Right.
this money and you said it was real estate, but it really wasn't, or whatever, right? Whatever it was. For the DST, that's what it happened. It's batting 1,000, meaning not one single issue with the IRS, not one single change, okay, in the 24 years. And so what we like to say is, hey, bring in your trusted advisors. We want their blessing, but realize, had they known about it, they would have told you about it. And B, also realize there's nothing that's incentivized for them to say yes. Right? There's
Yeah.
no upside for them. If they say yes to something they don't understand or fully know or fully comfortable with, they don't get anything. I mean, the business goes over here.
Right.
And so, although we have thousands of business professionals, by the way, we have national law firms who've said yes to this. We have thousands of financial advisors and their companies who allow their financial advisors to say yes to it. It survives scrutiny from FINRA, right? But the biggest ones are the IRS audits that it's survived with no changes whatsoever, including what's called formal audits. There's also a PLR, a private letter ruling. So it's 100% legal. It works every time, but it is new and people are cautious about it, which leads to the second question. How do you know the funds are protected, right? The funds only ever move with your signature. They're held at some of the largest banks in the world, TD Ameritrade, Charles Schwab, Bank of New York Mellon. They're held what's called a DACA account, which stands for Direct Access Control Agreement, which is basically like an escrow for the funds. Your funds don't move without your signature. As the trustee, which is my role, I cannot move the funds. It has to take your signature to move anywhere. That's all protected. It's all there. If you have your own financial advisor, they can join us and they can manage the funds. The fees are a little bit higher when they do that. If you we call that kind of going out of house with new financial advisors. But if you use our in-house financial advisors, you get a little bit of a break there. But it's your choice. We want to customize it so you feel not only safe with the legal part, but safe with the actual practical moving of the funds. And the last one is the audit defense, okay, and the indemnification. So the tax attorneys provide indemnification for the clients, as well as what's called audit defense for the lifetime of the trust, meaning they stand behind their work. And then collectively, we don't charge anything unless the client closes the deal. So you can talk with us, connect with us, we'll educate, we'll get everything ready to go. If the deal doesn't close or you decide not to do it, no problem. There's no pressure there. We want to make sure everything's in line, but we only get paid if and when you close, which also kind of speaks to who we are. A lot of tax attorneys will just say, yeah, Alpesh, come talk to me. Let me charge you
Right.
$500 an hour.
500 an
just
hour.
talk about stuff. We don't do that. We don't do that. We think we stand behind what we have and how we do it, and we get paid only if and when the deal actually closes.
So what kind of fees are there?
Great question, right? We must charge millions of dollars for all
of
of
course.
these So it depends on the size of the deal, but generally speaking, it's 3% to close the deal. Okay. 3%. 1.5% of that is to the tax attorney. Okay. And that's based upon the purchase price, the sales price of the asset. Okay. So that's pretty straightforward. That includes audit defense and the legal and tax structure. It covers, talking with your CPA to make sure everything is scheduled correctly. Talking with the brokers and escrow, basically making a seamless transaction as possible, and also follow-up questions that come, okay? So you're going to have that. That's all included in that one-time fee to them. Now, second fee is to the trustee and financial advisor, and that's typically basically 1.5% per year. Okay, just depending on how and where the funds are invested. So I like to say 3% to close because you're going to pay all that, and then once a year thereafter, it's 1.5%. 1.5% on the proceeds, though. Okay, so not on the sales price, on the proceeds, on the 1.5%. There's a $1,500 DACA account fee. It's the bank account fee. There's about a $1,000 tax return, which leads into the next question. Well, what numbers does this thing make sense? We found that $500,000 of proceeds for every $100,000 of liability. That's the minimum. Okay. Our average deal is about $2.6 million.
Wow.
We're deferring somewhere around $400,000 to $500,000 in tax. But if your deal only has $25,000 in tax or $50,000, just pay the tax.
Yeah, right? That's what I do.
If it only has $400,000 of proceeds, yeah, it's just too small because our fees are going to eat up the tax savings, right? So we have a DST calculator. So you can go to capitalgainstaxsolutions.com. You can go on that calculator, or if Alpesh, you might, if you join us, you might have that too. But the point is, we can get that all real clear up front. and then we can start to customize this wealth plan for you to
Okay.
figure out how this fits, what you're looking for. But the fees, obviously, the bigger the tax liability, the more the fees make sense. And yeah, hopefully that answers the question.
No, that's great. And I will put the calculator link in the show notes as well. But did we forget to discuss anything else? I think this was pretty helpful.
So we talked about the estate tax. We talked about optimal timing. We talked about the net income tax savings. I mean, I would just remind your listeners that what it works for. So we're doing cryptocurrency deal right now.
Oh, okay.
We're doing a racehorse deal right now. Of course, we've done every business you can think of: dentists, veterinarians, optometrists, professional practices, tech companies, self-storage facilities, multifamily, you name it. I mean,
Wow.
real estate business. We've done just about everything you could think of. Okay, so just think of it beyond real estate, or especially commercial real estate, because that's mostly where your listeners are at. Think about it for the primary home. We did a $26 million sale for our Newport Beach property. We helped the couple defer $6 million in capital gains tax. So those are really powerful. And then anyone who's listening who happens to be a business professional themselves. So if you're a real estate broker listening, if you're a financial advisor listening, business broker, mergers and acquisition attorney, we want to partner with you, and we want to equip you with this strategy and help you grow your business. Because let's face it, automation and technology is challenging the value proposition of every single business professional that are out there, right? The Redfins, the Zillows, you name it, there's challenging, and the fees are getting squeezed. I'm a commercial real estate broker myself too still, and I've seen it and I'm seeing it, right? It's happening. So how are you adding value beyond just what everyone else is talking about? And this is where, when you come into the closing table or for a listing or for an opportunity, and you can say, hey, I'm going to save you 30 to 50%. That represents, let's say, $3 million in a given case. That is tremendous value, which nothing else can do. You can get on the front page of Google, you can do all the social media, all the fancy drone shots, but at the end of the day, the client wants to know, what is your fee?
Right.
What are my net proceeds? And if someone can save me millions of dollars, so that's the first one. You're a business professional, go to Capital Gains Tax Solutions, connect with us, sign up with us, and get this opportunity to help more people out. And the other one will be for just the actual client. Just be proactive, be early to this process. The worst thing you can do is not take action right now and not equip yourself with this, and then you're all of a sudden 30 days to close, you're like, oh, or 10 days to close, and you go, oh, I remember I can do this.
Right.
No. Figure this out now. Get your tax deferred plan in place now. And then when you go to sell, your mind is completely clear of you already know where the money is going to go. You already have that in place.
Right.
Now you can focus on the negotiations. You can focus on making sure you're getting the highest and best price for your property or business. But when you combine the two, it becomes very stressful, because most people are not selling businesses or real estate every day, right? And this is the largest transaction you may ever do for yourself and your family. So you owe it to yourself to be early in the process with this, but even if it's a year or 2 year out that you're looking to sell, establish that plan and then establish the second one. Okay. And then the last thing I'll leave with the listeners is this. Part of our heart is not only helping you create and preserve more wealth, but it's actually unlocking capital so you can give more to charities of your choice. Okay. And here's
That's
the cool
so awesome
thing. It's completely optional. Right? It's not by force. Like charitable remainder trust, they 100% has to go away. But we want to be able to unlock capital for people so they can escape feeling hostage to the 1031 exchange or any other tax deferral strategy, so they can pour into people who need it the most. And that's the type of legacy that we're going to help you leave when you use this structure.
That's awesome. Thank you so much, Brett. How can my listeners reach out to you?
Yes, so I have a YouTube channel, and I have our website, and I have LinkedIn, but you can just search capitalgainstaxsolutions.com or just type Capital Gains Tax Solutions on all of those. And then our podcast is also releasing here soon. We already have 25 episodes recorded, and so we would love for you to also subscribe to that and start to get educated on the structure, any of those medias. And then you can also schedule, for your listeners especially, you can schedule a one-on-one 15-minute initial consultation call and just just make introductions and to get this going if this is something you're really interested in.
Thanks again, Brett. I had fun, and I Learned a lot today.
Thank you. My pleasure. And I look forward to helping anyone I can who's listening to this. And thanks so much for having me on the show.
Absolutely. Take care.